Stock splits and buybacks. What are they and what do they mean for investors? Hi everyone and welcome back to The Independent Dollar. We make new videos each week on personal finance topics in a way that is straightforward and easy to understand. In today's video, we're breaking down the basics of stock splits, reverse splits, and stock buybacks. Stock splits and consolidations occur when a company either increases or decreases the total amount of outstanding existing shares by redistributing shares to investors. A common stock split would be a 2-for-1 split, where for each individual stock an investor owned, they would now be issued a second share, bringing their total to 2. And typically, the price of each share would be reduced by half. So as an example, if you owned 100 shares of a company currently trading at $20, after the 2-for-1 split, you would now own 200 shares in that same company. As the value of the company is not doubled, each share is now worth half of what it was before. It would now be priced at $10 a share instead of $20. Even though there are more shares to buy, as an investor, your stake in the company remains unchanged, as does the company's balance sheet, as you can see here. A recent example of this would be TELUS, which in March just went through a 2-for-1 stock split. Why would a company initiate a stock split? One main reason for a stock split is to try and lower the price of each individual share, bringing a higher price stock back down to levels that are a bit more affordable for the average investor. This will help increase liquidity since there are now more able buyers available. If you only had $5,000 or $10,000 to invest, you might be more willing to invest in a company whose stock is trading at $20 versus a company whose share price is currently sitting at $100. In contrast to reverse splits, which we will be covering next, stock splits are usually viewed as being positive and can even drive prices upwards even if it's just in the short term. A lower price per share also makes it much easier to fit that stock into your portfolio when you're either adding to a position or rebalancing. Think of it this way. If you only had $160 to spend, you can buy 8 shares at $20 a share, but you can only buy 1 share that's currently trading at $100. That's less than 65% of what you would have invested in the company, and your remaining $60 is now going towards investing in another company altogether. That can have a huge impact not only on demand, but also the price of a stock. With that in mind then, what is a reverse stock split and how does it differ from a normal stock split? A reverse split is the exact opposite of what we just talked about, where a company takes all of the outstanding shares and reduces the amount of shares that they have by a specific factor, and then reissues them to their shareholders. So as an example, if a company were to initiate a 1-for-10 split, your 1,000 shares trading at 20 cents would now be reduced to 100 shares, now trading at $2 a share. As you can see here, a reverse split usually increases stock price as there are now less outstanding shares to buy or sell. However, company fundamentals remain unchanged. For existing investors, this shouldn't change the overall total value of your account, as the increase in share price would equally be offset by the lowered share count. So what would be a reason that a company would want to initiate a reverse stock split? One of the main reasons that a company will go through a reverse split is to increase their share price so they can maintain their status on a specific exchange. The New York Stock Exchange, for example, requires that a company's share price not fall below $1 for 30 consecutive days. Another reason is that some investment firms will only invest in stocks that trade above a specific price point, which means increasing their share price could allow a company to maintain or gain access to institutional investors that may otherwise not have been interested in them. So a higher price stock may now better position that company to raise additional future capital. If you've been following any of the cannabis companies lately, then you would have seen a long list of stocks with very volatile share prices, especially over the last 12 to 18 months. Aurora Cannabis has been no exception to this. As of Monday, May 4th, ACP was trading just above $1 on the Toronto Stock Exchange and only 70 cents on the New York Stock Exchange. So in order to maintain their status, Aurora must increase their share price to above $1 or suffer a forced delisting from the exchange. So in response to this, they've announced that they will be going through a 1-for-12 reverse stock split. So for an investor that currently holds 1,000 shares, for example, this now means that their total holdings will be reduced to 83 shares. Now, the reverse split could increase the share price to around $12 Canadian or about $8.40 US, allowing them to maintain their New York Stock Exchange listing and now source additional financing. If you followed our previous video on ETFs, then you might remember that they will follow an index quite closely. So if ACB was removed from the index, it would force all of those ETFs to sell their shares. This would cause immense downward pressure on the stock price for Aurora Cannabis. While in theory the total value of your investment should remain unchanged, unlike a stock split or a share buyback, reverse splits do not usually come from a company's position of strength and usually carry very negative market sentiment. While a reverse split may increase the share price in the short term, they offer little in the way of investor confidence and in some cases will not ease downward price pressure. So unless a company's fundamentals begin to improve, it is possible that a reverse stock split may further erode investor return. What about stock buybacks? How do those compare to a split and a reverse split? A stock buyback should not be confused with a reverse split. In comparison, a stock buyback is when a company purchases some of their own outstanding shares. This will effectively reduce the amount of shares that are out there to now be bought and sold. As a result of this, the increased demand for the stock caused by the buyback usually increases the price per share and also the equity position for each individual investor, as you can see below. What would be a company's reason, though, for buying back their own stock? Stock buybacks are one way to add shareholder value and also increase the stock price to a level that the company believes might be a bit more in line with what they're actually worth. If the stock is trading at a price that management believes is heavily discounted, it's a great opportunity for a company to repurchase their stock. Stock buybacks are also an excellent indicator to the markets that a company has great confidence in their near to long-term prosperity. Buybacks can also be used as an alternative to issuing dividends to their shareholders as a means of sharing in the profits. The excess profits remain within the company, allowing them a little bit more flexibility in the future should they need to issue more shares to raise more capital. The shareholders are in turn rewarded with a higher stock price. This wraps up our latest video on stock splits, reverse splits, and share buybacks. As always, if you have any questions, let us know by commenting below. Thank you so much for watching, and we'll see you back here next week.